Most people believe investing only matters when you have big money. They think $100 is too small to make a difference, too slow to change anything meaningful. But this belief is exactly why most people never build wealth. The truth is, wealth is not built by starting big. It's built by starting early and staying consistent. This sentence sounds harmless, but it quietly destroys financial futures. People convince themselves they'll invest later, once their salary improves or their life becomes more stable. But later almost never comes. Expenses grow, responsibilities increase, and investing keeps getting pushed back. The biggest advantage in investing isn't the size of your contribution, it's time. Time allows compounding to work. Time allows mistakes to be corrected. And time turns small, boring amounts into serious money without requiring extreme effort. To understand this properly, let's compare two real scenarios. Same market, same returns, no luck involved. Only one difference: when they start. This comparison alone explains why small, early investments beat large, late ones. Person A starts at age 25, investing just $100 a month. Over 30 years, they invest $36,000 in total. That doesn't sound impressive, but thanks to compounding at 8%, the final value grows to around $150,000, without increasing contributions. Now let's look at person B. They wait until age 40 to start investing. They still invest the same $100 every month, but they only have 15 years. Over that time, they put in $18,000. At an 8% return, it grows to roughly $35,000. Nothing went wrong. Time simply wasn't on their side. When you put the numbers side by side, the gap is shocking. Starting at 25 leads to around $150,000. Starting at 40 barely crosses $35,000. That's not effort. That's time doing the heavy lifting. Time quietly removes the need for extreme discipline later. The earlier you start, the less painful investing becomes. Time smooths mistakes. Time compounds consistency. Most people don't start early because early results feel boring. The first few years barely move the needle. It feels like nothing is happening. But that's exactly when the foundation is being built. In year one, your $100 a month doesn't impress anyone. You invest $1,200. The gains are tiny. This is why most people quit. But quitting here is the biggest mistake. In the first 5 years, growth is slow. You're mostly just stacking contributions. But beneath the surface, compounding has already started. You just can't see it yet. Between years 5 and 10, things change. Your returns start earning returns. The curve slowly bends upward. This is where patience begins to get rewarded. Now compounding becomes noticeable. Your money is finally working harder than you are. The growth no longer feels linear. It accelerates. At this stage, market growth adds more than your monthly deposits. Your $100 matters less than time itself. This is where late starters feel regret. Now your money is compounding on top of compounding. Each year adds more than the previous one. This phase feels almost unfair, but it was earned through patience. In the final years, the curve explodes upward. Most of the final value is created here. This is why starting early matters more than investing more. An 8% return isn't magic. Historically, it comes from long-term stock market investing, broad index funds, diversified portfolios, not speculation, ownership. Most people achieve this through simple tools. Index funds, tracking the overall market. ETFs, with global exposure. Retirement accounts that stay invested for decades. This isn't day trading. It's not crypto speculation. It's not chasing hot tips. It's boring, consistent, long-term ownership. You don't need thousands to begin. You need consistency and time. Starting small trains behavior. Scaling later becomes easy. Every year you delay, you lose compounding years you can never recover. Later investing requires higher contributions and more stress. Early investing buys flexibility. When investing becomes automatic, fear disappears. Money stops feeling scarce. You think long-term instead of month-to-month. The effort comes first. The results come last. Most people quit before results appear. Smart people wait. There is no secret strategy. Start early. Stay invested. Let time do what it does best. The value of $100 isn't the money itself. It's the years it unlocks. Time is the most expensive asset you'll ever buy. Wealth isn't built in one decision. It's built in repeated small actions over decades. This is how ordinary people become financially secure. The question isn't whether this works. The numbers already prove that. The real question is when you begin. The earlier you start, the less you need. The later you wait, the harder it becomes. Time is the multiplier you can't replace. If you want to understand money clearly without hype or confusion, follow the Money Mind. We break down finance simply, calmly, and honestly so you can make better decisions for your future.